Today in accounts, we will start part 2, lesson number 1, accounting for share capital. In this, according to the reduction of syllabus which is being given by Gujarat board, point number 2, 10, 14, 15, 16 and 17 are omitted. In point number 3, types of preference share is omitted, whereas meaning of share and share capital that you have to do. Now we will start our point number 1, that is introduction. Company form came into existence after Industrial Revolution. So if a question is asked that when did company form came into existence? So company form came into existence after Industrial Revolution. Fine. Now further what they have told, due to limitations of proprietorship and partnership firm in carrying out business on large scale. Why did company came into existence? So because of the limitations of proprietorship and partnership, company form came into existence. In the modern age, capital is required for the business. So company collect its own capital from several persons. Joint stock company is an association of person. See, what do you mean by joint stock company? So joint stock company is an association of person and has an objective of carrying out some business for profit. It means they are running the business for profit. Company has a separate legal existence by law. Incorporation, management and winding up of company are governed by the provisions of Companies Act. Remember this also, that all these things in company are taking according to which provisions? So according to the provisions of Companies Act. In India, first time a separate act for the company was made in 1956. It is known as Companies Act. So first Companies Act came into existence in 1956. Recently, Indian government has incorporated New Companies Act. It means some new amendments, some changes are done. Amendments mean changes, okay? So, the act which came in 1956, in that certain amendments, certain changes are done and a New Companies Act came into existence in 2013, okay? So, first Companies Act came into 1956 and again a New Companies Act came into existence in 2013. With some amendments, that is with some changes. Fine. This chapter deals how a company raised the capital. It discusses several points in the reference and the accounting effect in the company's book as per the Companies Act 2013. Now see what you are going to study in this particular chapter. That is, when a company is started and company is doing the business, they need a huge amount of capital. The company itself, they are not having that amount of capital. So what they are doing, they are borrowing the amount of capital from someone, that is from common people, that is public. So when the amount is borrowed from the public, it is known as share capital. Into small denomination parts, company is taking money from public, that is known as share. And in this particular chapter you are going to study about that share capital only. Now for this, how the accounting entry is being given, that you are going to study in this particular chapter. Clear? Now then after that, point number 2, that is omitted. So we will be moving to point number 3. Okay, so your point number 2 is omitted. Fine, this concept is omitted. We will see point number 3, that is share and share capital. So meaning, nature and type. See, first of all, capital of company is called share capital. What do you mean by share capital? So the capital of company which is being invested, that is the amount money is invested in the company, okay? So that capital is known as share capital, which can be divided into transferable small denomination. Each such unit of denomination is known as share. So that lump sum amount of share capital is divided into small parts, which is purchased by the common people, that is public is purchasing that shares, okay? So see further. To raise capital, company issue prospectus, that is they give the advertisement in the newspaper as required by law and invites public. It means they are informing public to purchase the share. Those who purchase share of a company are called the members or shareholders of company. So those who are purchasing the shares of that particular company are known as members or the shareholders of the company. As long as the shares are held by this person, he is called the shareholder or co-owner of the company. For shareholders who has purchased or is in possession of the shares, indicate the proportion of his ownership in the company. For example, I have 40% or 20% or 10% of the shares of that particular company, or 5% or 2%. So I am holding that particular ownership in the company. Each share is allotted a distinctive number. See, each and every single share is having a separate distinctive number. For example, in classroom there are 50 students, so each one of you are having a specific roll number. Same way, each shareholders, those who are having the shares, okay, they have a certain distinctive number. That is, from number 1 to 20 the shares are with this person, from 21 to 30 the shares are with this person, 31 to 35 the shares are with this person. So each number is having some distinctive number, which can be either in 5 digit or 6 digit. Share is an asset which is movable and transferable. So what is share? Share is one type of asset and it is movable and transferable. It means you can transfer that share to any one person. Today, for example, I have the shares of Reliance company. I can transfer this share or I can sell this share in the market. Then whosoever is the owner, that will be having the ownership of that particular shares. According to Companies Act, a company can issue two types of share, may issue two types of share, that is preference share and equity share. Okay, so this already you have learned what do you mean by share, preference share, equity share in 11th standard in OC. Okay, again this is just a revision. Preference share. So what do you mean by preference share? The shareholders, those who are getting the first preference to get the dividend or at the time of getting the money back from the company, they have the first right to receive the capital also. So that is either at the time of liquidation or at the end of the company. Okay, that is liquidation itself. So during that time period, the shareholders, that is the preference shareholders, will get the first right to get their money back. So they are known as preference share. See, we will see preference share is one of the given preferential right to the holder for receiving the dividend at a specified rate before any dividend is paid to equity shareholders. See, equity shareholders will get the dividend afterwards. First, the preference shareholders will get the dividend. If some profit is left out, then the equity shareholders will get the dividend. Otherwise, they will not get. When the company goes into liquidation, the preference shareholders have the preferential right for the repayment of capital before the equity shareholder. So again, in case of repayment of money also, first right is with the preference shares. They will get their money first back, and then if the money is left out, then only the equity shareholders will get the money, otherwise they won't get the money. So remember that in case of dividend and in case of capital, okay, first right is being received by the preference shareholders to get their money. Clear? So that is known as preference share. This types of preference share is omitted. It is not there in our course right now. Clear? Then we'll see equity shareholders or ordinary share. The shares which are not preference shares are known as equity share. Okay, those who are not preference share, they are known as equity shares. So remember this much, that is the shares which are not preference shares are known as equity shares. Clear? Then see, for getting dividend also, company gives dividend on equity share every year on the basis of current year profit of the previous year, accumulated reserve. Okay, so first the preference shareholders will get the dividend and then only equity shareholders. Same way at the time of liquidation also, first the preference shareholders will get the money and then only the equity shareholders will get the money. Equity share capital is known as principal share capital. What is the another name of equity share capital? So that is principal share capital. Okay, this is the spelling of principal, see it carefully. According to current provision of Companies Act, the equity shareholder have minimum face value of ₹1. What is the minimum face value for the equity shareholder? So for equity shareholder, the minimum face value is ₹1. In the present scenario, most of the companies have the face value either ₹1, ₹10 or ₹100. Okay, but for MCQ or for answer in objective, remember this, that equity shareholder, what is the minimum face value price? So that is ₹1. Clear? Now we will see the difference between preference share and equity share. See, preference share dividend, they will get the first right at a fixed rate. Equity share, after giving the dividend to preference share, if something is left out, then the equity shareholder is given the dividend. Here the rate of dividend is not fixed. See, your rate of dividend is fixed. Here why the rate of dividend is not fixed? Because it depends upon what amount of profit is left out. Clear? Then preference shares, arrears of dividend. If dividend is not paid on cumulative share in any year, the arrears of dividend is paid against company profit in future. See, suppose cumulative. Cumulative means if this 1 year there is no profit, then the preference is not given to dividend is not given to preference shareholders. Okay, second year also there is no profit, so no dividend is being given. Now third year, when the profit is earned, you have to give compulsory all the years profit, that is for the dividend, that is for first year, second year and third year. It means cumulative, it is added, and then altogether for the 3 years the dividend is given to the shareholders. Okay, so here in preference share, the dividend, if it is accumulative, okay, so in that case arrears of the dividend of the previous years are also being given. Here whatever is gone is gone. Okay, here there will be no accumulated. Okay, so only the year where it's, for example, first year there was no profit, no need to give the dividend. Second year also there was no profit, no need to give the dividend. Third year now there is profit, so you will give the dividend only for third year. You won't give the dividend for the first and second year. Okay, that is known as arrears of dividend on equity shareholder cannot be accumulated, and so it is not paid against company's profit in future. Then see, preferential right on the payment of dividend. They have a right to receive dividend before any dividend is paid on equity share. So equity shareholders will get at the end. First who will get? So the preference shareholders will get the dividend. Payment of dividend on equity share is made after the payment of preference share. Okay, so here dividend is been given to equity shareholders, afterwards the preference share. Then preferential right at the amount for the payment of capital. Here they get the capital first. If anything is left out, then after paying the capital to preference shareholder, if something is left out, then only equity shareholders will get the amount of capital. Preference shareholders do not have any voting right, whereas equity shareholders have the voting right because they are bearing the risk. Okay, so as they are taking the risk that they can get the amount of capital or dividend, they may not get. So this risk is borne by only equity shareholder. That's why voting right is also being given only to equity shareholder, and it is not given to the preference shareholder. Right to participate in management. They do not have any right to participate in the management of the company. They have full right to participate in the management of the company because they are bearing the risk. So this is the difference between preference share and equity share. Fine. Then next is types of share capital. See the first point, authorized nominal registered capital. Fine. What do you mean by this? See, these are types of share capital. Fine, not types of share. Okay, types of share means preference share, equity share. This is types of share capital. So the first one is authorized nominal and registered capital. The maximum amount which a company can accumulate by share capital during its lifetime is called authorized share capital. It means whatever amount the company, maximum amount the company can take from the public during its whole lifetime, that amount of capital is known as authorized nominal or registered capital. If in board exam they are asking you what do you mean by authorized nominal or registered capital, you have to write down only this much. Fine. It is stated in the memorandum of association and also stated at the time of registration. Hence it is called registered capital. Thus it is also known as registered capital. If there is a need to increase the authorized capital of a company in future, the same can be increased by passing a resolution in the general meeting of the shareholder of the company and also as per the Companies Act. Suppose if you want to increase your limit, okay, so then you have to arrange a board meeting, and in general meeting you have to pass a resolution, and then only you can increase your limit for nominal or authorized capital. See here they have given an example. Authorized capital is also called nominal capital. For example, authorized capital of ABC Limited, that is 1 crore divided into 10 lakh equity shares of rupees 10 each. See how many shares are issued in the market? 10 lakh. Each share, it means one share is of rupees 10. So 10 lakh shares are of rupees, that is total. The multiplication of both of this, it's coming to 1 lakh. It means the company can take money of 1 crore during its whole lifetime from public. They cannot increase this limit. If they want to increase this limit, they have to arrange a board meeting and they have to pass the resolution in the board meeting. Okay. Now it is not necessary that company will demand full 10 lakh, company will put all 10 lakhs equity share in the market as and when required. Okay. Suppose right now there is only need of 50 lakhs. So they will issue only 5 lakh equity shares of rupees 10 each. So 5 lakh multiplied by 10. So they will be receiving 50 lakh. And as and when they require, slowly they can ask the amount. Fine. So second, that is issued capital. Now see here the limit is 1 crore. It means only 10 lakh equity shares are issued. Now what do you mean by issued capital? The share capital issued by issue of share out of authorized capital based on the need. Suppose I need only 5 lakh, so I am issuing only 5 lakh. So that is issued capital. Here they have given an example that there is need of only 70 lakhs. Okay, so they are issuing only 7 lakh shares of each 10. So 7 lakh into 10, that is coming to 70 lakhs. So whatever they need from this, they will issue only that much in the market. Okay, so they have issued 7 lakh equity shares. So still 3 lakh equity shares are kept as aside as a reserve. Okay, so that is known as reserve capital. Okay, here it is 10 lakh. From 10 lakhs, okay, they have issued how much? 7 lakh they have issued. So 3 lakh will be treated as, that is reserve capital. So whenever they need in future, so during that time period they will demand this 3 lakh. That is 3 lakh multiplied by 10. So 30 lakhs amount they have kept as a reserve capital. Fine. So that is known as issued capital. Okay, so issued capital is still here, and then they have given the example. Now after that, subscribed capital. See, this is in a sequence. So remember, in a sequence only. First will be authorized capital. After authorized capital, there will be always issued capital only. Okay, issued capital. After that, there will be always subscribed capital. So here the company is demanding shares, that is putting the shares for issue of 7 lakhs. So what you are receiving from the market is known as subscribed capital. Okay, in market you have kept 7 lakh. What you receive from the market is known as subscribed capital. So the value of share for which application are received. See, here there is received word, here there is issued word, and here there is, that is the maximum amount which a company can take from the public during its whole lifetime. Okay, so the value of share for which application are received out of issued share capital is known as subscribed capital. Subscribed capital can be equal or less than the issued capital. It can be 7 lakh, it can be less than 7 lakh, it can be more than 7 lakh also. Even if share application are received for more than share, then the issued company can allot shares only to the extent of shares issued. For example, see, they have kept in the market 7 lakh. They can receive less than 7 lakh. They can receive more than 7 lakh also. That is, for example, they are issuing 7 lakh share, but they are receiving 8 lakh share. Okay, so your company cannot take 8 lakh into 10, that is 80 lakhs. What the company will do? Company will keep only 70 lakh with them, and 10 lakh they will again give back. Okay, this 10 lakh what they have to do? They have to give back. It means they will reject this share. Fine. So extra amount if you are getting, if the company is very good, the reputation is very good in the market, then the company may get more shares also as per the number what they have issued. So this extra shares what they have to do, they have to give back to the shareholders. They have to reject these shares. Fine. So that the company, whatever they are receiving out of the issued share are known as subscribed capital. Moving to next is called up capital. Called up capital means, see, for example, the value of the share is 10 rupee. Now 10 rupee is divided into parts. For example, first level is known as application. For that it is 3 rupees. Second level is known as allotment. This you will study. That is for 2 rupees. Third level is first call. That is, for example, again 2 rupees, and then final is for rupee 3. So now see, the total becomes 10. So called up means the company has called up 3 rupees for application. Allotment also they have called up. They have not called up this 2. Okay, so what will be the called up capital? Whatever the company have taken from the public out of that 10 rupees is known as called up. Company is demanding. Company has demanded 3 rupees, 2 rupees, this 2 rupees also. So total how much the company has demanded till now? They have demanded 7 rupees till now. Okay, so company can call up an amount equal to face value. Either they can call up altogether 10 rupees or lesser amount from the application to whom the shares are allotted. When the company call for lesser amount of the share, the balance amount can be called in future. See, the company has called this 3, so this 3 rupees company may call up in future at the whenever needed. Such amount of called up share is known as called up capital. For example, if the company has called up 6 per share, so 6 into 7, it means total 42 lakhs the company has called up. See, out of 10, 6 is called up. So what is not called? 4 rupees. Okay, that will be called uncalled amount. Okay, so here 4 rupees is known as uncalled. That is 4 sevens are 28,000. See, here they have given uncalled capital. Okay, so it is a part of subscribed capital, a capital which is not yet called from the shareholder. Okay, that is known as uncalled capital. So here 6 rupees is called up. It means 4 rupees is yet not called up. For example, if I have given here the amount 7 rupees. Okay, so 7 is called up. So this is uncalled. 3 is still to be called up. Clear? Now, what do you mean by paid up? Paid up means, see, company has called up, for example, 3 rupees, 2 rupees, 2 rupees. Out of this, only they have paid, that is shareholders have paid only 2 level. It means this is paid up capital and this is known as unpaid capital. Fine. So see, the amount received by the company from the shareholder, one of the called up amount. See, called up is for you is 6 rupees. Now, out of 6 rupees, the company has paid how much? See, so here, for example, we will see what they have given. See, called up is 7 lakh into 6, 42 lakh. If a shareholder holding 1000 shares could not pay first call money of 2, then paid up capital. So from this, I will deduct this 1000 into 2 rupees. So if I am deducting, so this is known as paid up capital. Okay, and this is known as, this 2000 is known as unpaid amount. Okay, one of the party has not paid, so this 2000 is unpaid. It means this much is paid up capital. Reserve capital. Reserve capital, see, here I taught you what do you mean by reserve capital. From this 10 lakh, I have demanded only 7 lakh right now. So this 3 lakh will become reserve capital. Whenever the amount is needed in future, so that time period, this reserve capital will be demanded by the company. So see, what do you mean by reserve capital? When management of the company feels that the called up capital is sufficient for the business requirement of the company and no further capital is required in future, the uncalled capital is converted into reserve capital by passing a special resolution in the meeting of the shareholder. Capital so reserved is known as reserve capital. Such reserve capital can be called up from the shareholder only when the company goes into liquidation. So as this is not needed, the company has converted this 3 lakh into reserve capital. Now when the company is going into liquidation, at that time they need money. So this 3 lakh will be taken at that time. So 3 lakh multiplied by 10 rupees. So 30 lakhs will be taken from the public during at the time of liquidation. Fine, that is known as reserve capital. Such reserve capital can be called up from the shareholder only when company goes into liquidation. Special resolution passed to this effect cannot be cancelled. As you have kept this amount in the reserve capital, so that special resolution you cannot cancel. Once you are taking that special resolution, see, by passing a special resolution, so once the special resolution has been passed out, you cannot cancel this special resolution. Okay, so if you are sure, then only put this amount in a reserve capital, otherwise don't consider it. Next is, see, next is capital reserve. See, this was reserve capital and here this is capital reserve. Now what do you mean by reserve capital and what do you mean by capital reserve? Okay, so see, capital reserve are those reserves which are created out of capital profit. You have learned in 11th standard capital profit and revenue profit. Revenue profit is earned on a regular basis. Capital profit is not earned on regular basis. It is earned only sometimes in business. So capital profit are those profit which are not earned in normal course. Okay, that is on regular basis you are not earning. This reserve cannot be utilized for the distribution of dividend. You cannot utilize this capital reserve for distribution of dividend. So remember this also for your objective question, that which type of reserve is not utilized for distribution of dividend or where capital reserve cannot be utilized. Following transactions give the rise of capital profit which is to be transferred to capital reserve. So out of this 6 event you get capital profit. Okay, what do you get? Capital profit, and this profit you can convert it into capital reserve. In this chapter you are going to study this point. Okay, in this point you will find out that you are getting capital reserve. See, one is profit on sale of fixed asset, profit on revaluation of fixed assets. See, in admission and retirement you have seen revaluation. First the land and building was of 1 lakh. Now the value of that land and building becomes 1,50,000. So 50,000 has been increased. So that is profit on revaluation. Profit prior to incorporation of a company. In 11th standard you have studied that company gets the certificate of incorporation. So before getting the certificate of incorporation, fine, whatever profit, whatever business you have done, okay, so that profit is known as profit prior to incorporation. Premium on issue of shares and debenture. This we are going to study. What do you mean by premium? What do you mean by profit on redemption and profit on reissue of forfeited share? Okay, all these 3 points you are going to study in this particular chapter. Fine, that we will discuss later on. Point number 4, steps for issue of equity share. Okay, so when you are issuing equity share, what are the steps? See, company raise its capital by issuing equity share to public or by private placement. So either they will issue in public or privately they will give the shares to either workers, employees, relatives, friends, like that. That is known as private placement. Detailed discussion information about this is as under. See, first of all, for shares issued for public. Okay, so when you are issuing the shares for public, what are the steps? So see, permission for issue. So first of all, you have to take the permission from Government of India for issuing the shares of your company. Government of India made an important amendment in 1991 by repealing Capital Issue Control Act 1947 and established Securities and Exchange Board of India, which is known as SEBI. Earlier, the company were required to seek prior approval of government for public issue of shares, but now such companies will have to prepare an offer document in accordance with SEBI guidelines and other legal requirements and submit the same to SEBI. So previously what was there? They were supposed to take the approval of government for the public issue. Now what they have to do, the companies, they have to prepare an offer document, and that offer document should be according to the guidelines of SEBI, and they have to submit the same again to SEBI. Only after the verification of offer document by SEBI, they give permission for the public issue of the shares to the company. So previously it was that the approval was being taken from the government. Now the approval has to be taken from the SEBI, that is Securities Exchange Board of India. Second point, details of proposal to be sent. See, first of all, for permission we have to make an offer document. Now that offer document, that is known as proposal, is to be sent to SEBI. In the offer document or proposal, the company has to disclose the number of shares issued. It means how many shares you are supposed to issue, type of shares issued, either it is equity, preference, which type, issue price of each share, it is 1 rupee, 10 rupee, 100 rupees. In addition to this, details regarding full amount to be paid at the time of application or amount to be called up in installment is also provided. For example, 10 rupees the price of the share. This you are asking in 3 installment, 4 installment, that you have to mention. Next is offer to public. After complying with the formalities relating to public issue, the company invites public. That is, they give the advertisement in the newspaper for inviting the public for subscription to share by issue of prospectus. That is, advertisement is to be given in the newspaper or TV. Company inform the details about the subscription of share to public by newspaper. By and large, it is given by newspaper or by TV or by hoardings. Clear? Fourth point, details shown in prospectus. Now, in prospectus, which type of details you are supposed to show? So see, normally following content are shown in prospectus: name, address of registered office of the company, name and address of directors, object of the company, that is objective of the company, risk involved in company, consent from SEBI, authorized and issued capital of the company. Authorized and issued capital, already we have discussed. Authorized capital means how much is your total limit which you can take from the public. Out of this total limit, how much you are asking from public is known as issued. And the numbers of shares now offered for subscription, dates of opening and closing of issue, name and address of merchant bank, in which bank your account is there, guidelines about past years and future working of the company. So all these details you have to mention in the prospectus. Next is for share application. After reading the prospectus, that is either through TV they are knowing or through hoarding or by newspaper they are coming to know about the prospectus, the public applies for the share in the company in a prescribed form. Each application must accompany the number of shares applied, name and address of applicant, the bank account number, their name and number of demat account, and also amount of total application money. So all these details should be there. The amount of share application money by check or draft with application form must be deposited by the applicant in the scheduled bank which is specified by the company. The name of the scheduled bank is mentioned in the prospectus. In the prospectus, the name of the merchant bank. See here it is given a merchant bank where your account is there. So that will be disclosed in the prospectus. Provisions for the amount to be called up on application are as under. See, according to section 39 of Companies Act 2013, application money on share should be minimum 5% of the face value of the share. Okay, so here this you remember that according to Companies Act, okay, what will be the minimum price? That is 5%. So for example, face value of the share is rupee 10. Fine. So what will be the minimum 5% of 10 rupee? That is 0.50 rupees. Clear? So here according to Companies Act, okay, the application money on share should be minimum, okay, that is minimum 0.50 at application level. Maximum they can take whatever they wish, okay. They can take full amount also, they can take in parts also. But according to Companies Act, according to the rule, minimum 5% of face value should be asked during application. Next, as per the present rule of SEBI, this was according to Companies Act, now this is according to SEBI. The amount to be paid with application of share by applicant should not be less than 25% of the issued price. Issued price is means same, that is face value. Clear? Of the share. So suppose now here your face value is that is 10 rupees. Okay. So what will be the 25% of this? So 25% of this will be 2.50 rupee. Okay. So here according to SEBI, it should not be less than 2.50. Fine. And according to Companies Act, it should be, that is minimum 0.50. So this 2% you have to remember. According to Companies Act, it is minimum 5%. According to SEBI, it is should not be less than 25%. Clear? As per section 24 of Companies Act 2013, SEBI provisions are applicable for the issue of any security, and its transfer provision as per the Company Law Board has not been applicable. Okay, so here there is, according to Companies Act 24, SEBI provisions are applicable for the issue of security. Now, according to 2013, what they are telling that SEBI provisions are applicable, that is this 25% is applicable for the securities and its transfer. Provision as per Company Law Board has not been applicable. Now this is not applicable, only this is valid. Clear? In the present scenario, according to SEBI guidelines, new arrangement has been established for share application in the public issue of the company. It is known as ASBA. Okay, the full form of this ASBA is given in your textbook on page number, that is 55. See, ASBA, application supported by block amount. Okay, so this is not in your course right now, because according to the reduced syllabus, this portion is not there. Okay, so only remember what is the full form of ASBA, that is given on page number 55, that is application supported by block amount. ASBA is a process. Now what is this? So it is a process developed by Indian Stock Market Regulator SEBI for applying to IPO. What is IPO? We will see. In ASBA, an IPO applicant account does not get debited until the shares are allotted to them. Until and unless they are not receiving the shares, their account will not be debited. What is this IPO? We will see here. Fine. So here remember ASBA. Okay. So that is whenever the company is issuing the share, the public can go through, they have to go through this ASBA process. To make the student familiar about this arrangement, a detailed information is given that I have shown you. Next point is when shares are allotted. See, now here people have applied. Okay, how they will come to know that they are got the shares or not? So the now company will inform the applicants that you have been allotted this many shares. See, sometimes it is like that company is issuing 1 lakh shares and they are receiving 1 lakh 50. So 50,000 they have to reject because they have to keep only that much shares which they have issued, that we have already seen in issued capital. Okay. So here sometimes it is possible that I have applied, but according to the rejection, I am in the rejection list and I am not getting any shares. Okay. So now the company will inform that to whom they are giving the shares and to whom they are not giving the shares, or to whom they are giving the partly shares. Okay. Sometimes it is also possible that I have applied for 5,000. The company is giving me 3,000. So that is also possible. See now. When the company received the application forms, the shares are either fully or partially allotted to applicants. Either they are giving fully or partially, which I showed you that I have applied for 5,000 and they have given me 1,000 or 2,000. Those who applicants who are allotted shares are sent letter of allotment. Okay. So who receives letter of allotment? So those who are getting these shares. Okay. The company is allotting the shares, they will be getting letter of allotment by the company, in which number of shares allotted by the company to them are indicated. That means how much shares the company have given them, that is indicated. Those who are not allotted any single share by the company are sent letter of regret. So those who are getting the shares, they are getting letter of allotment. Those who are not getting a single shares, they are getting letter of regret along with a check for the refund of application money. Whatever amount for application money they have given, the check is given back. That is, the amount is refunded. It is directly deposited in the applicant's bank account. If company receive more or less number of share applicants, then the total number of issued share from the applicant, then provision for this has been discussed in the next point of this chapter, that we will see that more or less. Okay, that is over subscription or under subscription. Okay, what do you mean by over subscription? If I have issued 1 lakh and I am getting from market 1 lakh 50, that is over subscription. If I have issued 1 lakh and I am getting 90,000 or 80,000, so that is under subscription. That is more or less number of share applicants. We will see that. Next is balance amount by installment. Okay, whatever the remaining. See, now here according to clause, for example, 10 rupees there and 2.50 I have to ask. Okay, during application. So now what about the remaining amount? So the remaining amount, that is the balance amount, is being taken by the company in installment forms. See now. Generally, company calls for the full amount with share applicants or allotment. If company has not called a full amount with share applicants or allotment, the balance can be called up in one or more installment. Call must be made strictly in accordance with the provisions of Article of Association. See, remember here, first of all, the company is asking for full amount. In case the company is not asking for full amount, then there should be only one or more installment. Clear? Calls must be made strictly according to the Article of Association. In the absence of Article of Association, provision of Table F of Schedule 1 of Companies Act 2013 shall be applied. Suppose there is no Article of Association, so in that case, Table F of Schedule 1 of the Companies Act is applicable to that. Clear? Other important points. When shares are issued by the company has to necessarily contract with minimum one merchant bank or scheduled bank for its arrangement. For its transparency, also for financial transaction. Before, it means what they are telling in this point, that whenever the company are issuing share, they have to come in contract with one merchant bank or any of the scheduled bank. Before issue of shares, company has to compulsory contract with depository for demat of share. See, now you have learned in OC also that nowadays the shares are not given in a physical form. It is stored in an electronic form. So if you want to purchase shares, there should be compulsory a demat account. Fine. So next thing is you have to keep in mind that you should be in a contract with any of the depository agencies, either private or government agencies, and you should have a demat account. Sometimes company give an option to the shareholder to get the shares in demat form or in physical form. In present circumstances, it is compulsory to open a demat account. Okay, nowadays the physical form is not there. Compulsory you have to get a demat account. Any person can open or keep demat account in any bank. Nowadays there are many private agencies, there are even banks, those who are providing this facility of demat account, who hold legal permission to keep the demat account. Fine. So these steps are for issue of share only in case of issued for public. Clear? Next point we will see. Before that, there is some details about again demat account. Demat account is just like saving account or current account. Fine, remember this also if asked in MCQ. Entry for money transaction are kept in saving or current account. In the same manner, entry for purchase and sale. See, in bank account, savings or current account, we are keeping the debit and credit of money. Whereas here in demat account, there will be debit and credit of shares, that is purchase and sales. Okay, if you have purchased, then there will be credit. If you are selling, then there will be debit. Okay, that is the shares are coming and going. When any person purchases the share, the number of shares purchased are credited. Fine, see here I have told credit, and means added to his demat account. And when any number of shares are sold, then its account is debited, means deducted from his account. So remember this point also for theory portion. Next, that is shares issued by private placement. Now you are giving privately to someone else, to any of the group of the companies or anyone else, in friends or anyone, your business, that is promoters or your relatives or your friends or your employees, anyone. Fine. So see, private placement. As per Companies Act 2013, a company may issue shares on private placement basis also. Sometimes the promoters of the public company are confident of raising capital through private sources and contacts. In such a case, the company does not invite the public to subscribe for the shares, but make private placement of the shares to promoters, their friends, their relatives, mutual funds, shareholders of the companies, non-resident Indians, financial institutions like LIC, UTI, ICICI. So it is possible that if the company has having enough confidence that through their own personal sources they can issue their shares, then they can go for private placement. When the shares are not offered to public, the company need not issue prospectus. Now, only in the case of when you are offering the shares to public, you have to issue a prospectus. Okay, it means in advertisement, in newspaper now you are not supposed to give the advertisement, so there is no need to issue prospectus. Fine. Instead of issuing prospectus, the promoters are required to prepare a draft prospectus, which is known as statement in lieu of prospectus. So you should understand what do you mean by statement in lieu of prospectus. See, in case of issuing shares to public, prospectus is important. That is, to give the advertisement in newspaper is important. Fine. Then only public will come to know about the issue of shares. But in case of private placement, there is no need to issue prospectus. So in place of that, what you will prepare? You will prepare statement in lieu. In lieu means on behalf of prospectus. So a special statement has been prepared and must file with the registrar at least 3 days before the first allotment, either the shares or debentures. So before 3 days you are giving your shares. Okay. So before that 3 days you have to register the statement in lieu of prospectus. In case of private placement of shares, the allottees will not sell their shares for a certain minimum period from the date of allotment. This period is known as lock-in period. Okay. Now see, what do you mean by lock-in period? In case of private placement, they have to keep this shares which are being issued by the company on the basis of private placement. Whosoever are the receiver of this share, they cannot sell this particular shares for a certain period of time. And for that certain period of time, they have to keep these shares with them only. So that period is known as lock-in period. Clear? Now let us see point number 5. Oversubscription and undersubscription of shares, which I have already discussed. We'll see. If applicants are received for more number of shares than the shares issued for public subscription, it is known as oversubscription shares. Okay. For example, see, we have issued only 1 lakh shares. Okay. But from market, the reputation is very good of our company. So we are receiving 1,50,000 shares. See, I am not talking about rupees, I am talking about number of shares. Fine. So we have issued 1 lakh shares and we are receiving 1,50,000 shares. So it is known as over subscription. As company cannot allot more shares than the issued shares, it has to refund excess application money to the applicants of the share. See, there is a rule, the company, whatever they have issued, so they have to keep only this much with them, and whatever extra, so the extra is 50,000 shares, that amount will be rejected. Okay, so 50,000 multiplied by whatever amount they have taken at the time of application, that amount they have to refund back to the shareholders. In these circumstances, company may allot full number of shares Fine. Not allot any share or allot partially shares of the shares to the share applicants against their share application. See, what do you mean by that? Allot full numbers. For example, I have applied for 5,000, so the company will give full 5,000. Fine. To some of the people, they will not give a single share. So not allot any share. So to some of the few people. Now this will be taking place on lottery basis. Okay. So few of them will be given shares and few of them will not be given any share. They can also do that. They will give shares to everyone, but the allotted shares will be partially. For example, someone have applied for 5,000, so they will be given 2,500. Somebody has applied for 3,000, so they might give them 1,500 or 1,000, whatever. Okay, so the company can adjust by their own. Okay, this process is known as pro rata allotment, which is which is not there in your course according to corona situation. Okay, the course has been reduced, and in that reduced portion this pro rata allotment have been cancelled. Okay, so this concept you are not going to study right now. Next, see, if applications are received for less number of shares than the shares issued. For example, I have issued 1 lakh shares. Okay, and company is getting 80,000 or 70,000 shares. So according to the guidelines, that is known as under subscription. According to SEBI guidelines, company must get share application for at least 90% of the amount. So see here, they are getting 80%. 80% is less than 90%. This minimum amount of subscription should be received within 30 days from the date of issue of prospectus. If company fails to get minimum subscription, see now this amount, how much time they have to wait? They have to wait. For example, today prospectus, it means advertisement is given in the newspaper. They have to wait for the 30 days. Up till 30 days, they should receive 90%. Otherwise, they have to give the money back to the shareholders. See, they have given. If company fails to get minimum subscription, that is 90%. See, this is minimum subscription. That is less than 90%. Company is not able to get 90,000. If the company, what they have to do, so they cannot allot any share, and within 15 days, total amount should be returned to the applicants. See now, if company is getting 1 lakh, okay, issued 1 lakh, they are getting 90,000. So they can keep with them these shares. The company can utilize the money for these shares. But if the subscription is less than 90%, that is 80,000, so in that case the company has to pay back all the amount which they have received within 15 days. Okay. If the company fails to return this amount within 15 days, then the rate of interest is 15% per annum for each day. Okay, so this you remember, that if the company is getting less than 90% and company has to pay back this money back to the shareholders within 15 days, then in that circumstances 15% per annum they have to pay the interest to the shareholders for each day. We will see the next concept, that is IPO and FPO. We have seen in ASBA. Okay, that is IPO. What is IPO? See, an initial public offering. The full form of IPO is initial public offering. Is the first time that the share stock of a private company is offered for the purchase to public. It means for the first time that particular public company is issuing its shares to the public. What is FPOC? If a company has already issued the share to the public through IPO process and wants to increase the capital fund, then follow-on public offer is issued by the company to the public or to the investors. That is follow-on. F stands for follow-on public offer. I stands for initial public offer. So when any company, they are issuing first time their shares in the market, that is known as initial public offer. Already they have issued once, and again for the second time they are issuing their shares in the market. So that is known as follow-on public offer. Clear? So this is IPO and this is FPO. Next, methods for the issue of shares by the company. Company can issue its shares by 3 ways. Okay, which are that 3 ways? We'll see. First, see, at par. What do you mean by at par? At par means no premium, no discount. Fine. What do you mean by this? That is no premium, no discount. Clear? If the total amount payable by the share subscribers to company is equal to the total face value of share, the shares are set to issued at par. That means 10 rupees share is the face value and they are being issued in the market at 10 rupees only. So there is no extra amount charged, or there is no amount of discount which is deducted. Okay, so there is no premium, there is no discount. So that is known as at par. Second, at premium. If the total amount payable by the share subscriber to company is more than the total face value of the share, the shares are said to be issued at premium. For example, if the share's face value is 10 rupees issued at price of 14, see, the face value of the share is 10, but that same is issued in the market at rupees 14. So 4 rupees extra they are charging. That additional amount of 4 is considered as a premium. Present provision as per Companies Act 2013 and according to effect of shares issued at the premium has been discussed in detail. Later on we will see that all. Next is issue of shares at discount. If the total amount payable by the share subscriber to the company is less than the total face value. See, here in premium it will be more than, whereas in discount it will be less than. See, example they have given, face value is 10 rupee. These 10 rupee shares are issued in the market at 9 rupees. Okay, so that 1 rupee is considered as discount. As per section 53 of Companies Act 2013, companies would no longer be permitted to issue the shares at discount. Okay, so there are no sums. See, previously in the old course there were sums based on discount also, but according to 2013 Act there is no clause which is saying that the shares can be issued at discount. Okay, so now there are no sums for you for this point. Clear? The only shares that could be issued at discount are sweat equity share. Remember this also. Okay, only one type of share can be issued at discount, and that is sweat equity share, which is given to the employees or directors in lieu of their service. That is, in exchange of their service they are getting this. That's why it is known as sweat equity share under the section 54 of 2013 Act. Clear? So this is the point. Next is this point we will see that. Come to point number 9, that is on page number 13. Call in arrears. See, now what do you mean by call in arrears? We say it CIA. Okay, the full form of CIA is call in arrears. When company makes call for allotment money or call money, and if some shareholder fails to pay such money on due date, such unpaid amount is transferred to call in arrear account. In such case, there are two methods to deal with the accounting effect of call in arrear. See, now what do you mean by call in arrear? Suppose some of the shareholder, his financial position is not good. He has already paid application money. Okay, at the time of advertisement only that amount is to be paid. Second call also he has paid. Now third, when suppose third final installment is coming, he does not have any money, his financial position is not good, he is not in a position to pay that amount, so he is not paying that amount. Fine. So that will be treated as, that is CIA, call in arrears. It is also possible that some of the shareholders only pay application money, and after that whichever calls are coming, whichever installments are coming, they are not in a position to pay any single installment. So in that case also the amount will be transferred to CIA account. Okay, now there are two methods to keep CIA account. We will see that. First is without opening CIA account, where you will not open the CIA account. Next is by opening CIA account. Okay, now see, what do you mean by CIA? That is call in arrear when the party is not paying the amount to the company. That is, the shareholders are not paying the amount for that particular installment to the company, so it will be treated loss for the company. Okay, so CIA is nothing but CIA is one type of loss, and loss is always debited. So see, suppose we are asking for first call. Okay, so this will be the entry. See, can you see anywhere CIA account? So this is without opening CIA. I will teach you how to pass this journal entries, but right now just see that in first and second there is no CIA. So here CIA account is not opened. Whereas see, by opening CIA method, see here there is CIA and CIA is debited. Fine. So CIA is debited. Why it is debited? Because it is treated as loss. Okay, for company it is a loss, they are not paying. So see, for example, for first call the company will receive 1 lakh. Now one of the party is there whose amount is coming to 2,000 and they are not paying. So the company will get 1 lakh minus 2,000. So the company is getting the remaining amount for other applicants from other applicants, that is 98,000. Now afterwards, later on, if this particular shareholder is paying this amount back, so here right now we have debited, when the particular person is paying it back, so it will be credited. On receipt of arrears of call money from shareholder bank, that is, it will be credited. Fine. So see, here CIA is there, here there is no CIA. See here what they have done. Directly, how much has been received from the shareholder? 98. So you are directly 98. There is no effect for this person. Okay, that is CIA account is not opened. Okay. Then see here also directly bank account debited to first call. Okay, so that previously this amount was not received, now he is paying, so here it will be recorded. Okay, so this is, that is CIA. Okay, when you do the sums, this concept will be more clear in your mind. Now see, read this notes in this. This third point is important, that in case article of association, the company is silent, table F of company shall apply, which provides for interest at 10% per annum. However, the directors have to waive the interest on call in arrears. Suppose the party is not paying the amount and they are doing the payment late. So at 10% rate of interest, they have to pay the interest along with the principal amount. Fine. Now see, shares were issued with premium. Okay, that is more amount you are getting from the market for your shares compared to face value. When company has good reputation in the market, has high profitability, internal and external factors are favorable, and also if company have already issued shares in past and the market price of its shares are more than the face value of the share, then the company can issue the shares at a price more than its face value or nominal value. When company issues shares, okay, this is important. When company issues share at a price higher than the face value, it is known as issued at premium. Fine. When a share are issued at premium, the amount received in excess of face value is credited to a separate account, and that separate account is known as security premium account or security premium reserve account. Okay. For example, the face value is 10 and it is issued in market at rupees 15, then extra 5 rupees is your premium. Okay, and this amount will be, that is multiplied by number of shares, it will be credited to security premium account or security premium reserve account. Now in this particular chapter we have to remember only security premium account. Security premium reserve we will consider for the next chapter, that is debentures. So when shares are issued at premium, security premium account. When debentures are issued at premium, then you will write down securities premium reserve account. See what points you have to keep in mind. Amount of premium on share can be called along with share application or at the time of share allotment or at the time of application or allotment or at the time of them separately altogether. You can ask any time, okay, or at the time of application or at the time of allotment. There is no legal restriction on issue of shares at a premium, okay. Whatever amount you want to charge as a premium, you can charge. The premium on issue of share is one type of capital profit and not revenue. You are not getting premium on regular basis, you are getting sometimes. So premium on issue of share is which type of profit? So it is capital profit. Next, the balance of security premium is transferred where? So it is shown in the balance sheet on liability side, that is equity and liability, under the heading of reserves and surplus. Remember this, okay. It is shown on liability side under the heading of reserves and surplus. Amount of security premium cannot be utilized for the payment of dividend in cash. You cannot pay dividend from this amount. Clear? Now next, under section 52/2 of Companies Act 2013, the amount of security premium reserve may be used for the following purpose. You cannot use in dividend, so where you can use? So these are the 5 ways you can use the amount of security premium. First, in writing of preliminary expenses, that is fictitious asset if you want to write off, okay. Writing off commission or discount allowed on the issue of debentures of the company. Issuing fully paid up bonus, you can pay bonus from this, bonus shares. Providing the premium payable on redemption of redeemable. Redemption means repay. When you are paying back the amount of share to the shareholders, okay, that is redeem, that is repay. For buyback own shares, when you want to purchase your own shares from the market, you can use the amount of premium, okay. So this way you can use the amount of premium for shares. See, now next point is point number 12, page number 24. Forfeiture of shares. Now see, what do you mean by forfeiture? Forfeiture means close, okay? To shut down. Due to any reason, if any shareholder fails to pay the amount due on allotment or on any call within the specified time period, then company can forfeit its share by completing the formalities. If some certain person is not paying the amount, you have learned that if certain party is not paying the amount, then his account is to be transferred to call in arrears account, that is CIE account. After giving proper notice also, then also if suppose that particular shareholder is not paying, then after certain time period, what the company will do, company will close their account. It means company will forfeit the account of that particular shareholder. That is known as forfeiture of shares. In normal situation, directors of the company are empowered by the Article of Association company to forfeit the shares. Follow the rules laid down in Article of Association for the procedure of forfeiture of share, or if no rules are given in article for this, the provision of table of Schedule 1 of Companies Act 2013 shall apply. So process of forfeiture or cancellation of the shares by the director company is called forfeiture of share. After the forfeiture, the name of the shareholder is removed from the register of the members. Okay, remember this also. Because their account is closed, so their name will also be removed from the register. It means now this person is not a shareholder of the company. Fine. For forfeited shares, the amount already paid by the shareholder to the company is forfeited by the company. It means this amount is not returned to the shareholder. See, the party's account is closed. It means you are not supposed to pay the amount. For example, he has paid rupees 2.50 for application. He has also paid for allotment 5 rupees. Okay. Now the total price of the share was, the face value was 10 rupee. Okay. So 5 plus 2.50. So now only for final, that is the third call, that is for 2.50 rupees. Okay. This is not paid. Okay. But the shareholder has paid 5 plus 2.50. It means 7.50 he has already paid for one share. Suppose he is having 1000 shares. So 1000 multiplied by 7.50. Clear? So thus this 7500 the company is not going to return to the shareholders. Clear? Now see, number of shares decreased due to forfeiture of share and hence share capital account is debited. Here share capital account will be debited. The amount already paid by the shareholder in the company also gets forfeited with the forfeiture of share. Okay, that is the amount which is paid by the shareholder will go to forfeit account, that is forfeiture account, and the same is credited to share forfeiture account. So here just remember that share capital account is debited, that is the amount which according to the number of shares, whatever the amount they have paid up. Okay, here share capital means here there will be amount called up. Okay, whatever the company has called up till yet, okay, that amount is to be coming here, that is share capital account. And here forfeiture account, whatever is already paid, that amount will come here. Okay, this will be more clear when you will do the journal entries. Okay, but in short just remember this, that for example 10 rupees is the face value, application level is of 2.50 rupees, allotment is of 5 rupees and final call is of 2.50. This too the shareholder had paid and shareholder had not paid this level. Okay, so your call in arrears will come. Fine, how much it is paid? So 10 out of 10 rupees, 5 plus 2.50, that is 7.50 is paid. Okay, so that is 7500. Clear? So like this. And what would be the called up amount? Called up amount, all 10, see final call is not paid. So when you will come to know that it is not paid, when you will ask for that money, then it is known to us that it is not paid. So here what you will do, number of share forfeited, amount called up per share. See, amount called up. So called up amount is full 10 rupees because this is already received, this is also already received, this we have demanded and the shareholder is not paying. So we are coming to know that this is not paid. Okay, so here called up is all three, that is 2.50 plus 5, 2.50. So here the number of forfeited shares will be multiplied by rupees 10. Okay, and here it will be multiplied with the amount which is paid by them. Clear? and then whatever arrears level is there, that will account will be credited. This will be more clear when you will do the journal entries. Okay, so this is the concept. Issue of forfeited shares, that is on page number 27. Company can reissue forfeited share for this. Directors of the company have full authority by law. Okay, what do you mean by reissue? See, forfeited. Okay, one party is not paying, his account is closed. Again, that number of shares are reissued in the market and it is sold to someone else. Director can reissue them at par, premium or at discount, but discount is not possible for see here you can your discount is there. Okay, for the issue time discount is not there, but at the forfeiture time discount is there possible. Okay, on reissue of share, the company must get at least an amount equal to the amount not received on applicant capital account. It means at the time of reissue, if the forfeited share, company can give maximum discount to the new shareholder up to the amount of forfeited. What do you mean by this maximum discount? So see, in this case here we have seen that here the party, the price of the share is 10 rupee. Okay, and here, so see here in case of forfeiture we have seen that the company is paying 2.50 for application, 5 rupees for allotment, and final for 2.50 which the company has not paid. Okay, so sorry, the shareholder has not paid. So in total how much the shareholder has paid? 7500 the shareholder has paid. Okay, now the face value is 10 rupee. So total how much they were supposed to receive from this particular shareholder? That is 10 into 1000. So 10,000 rupees they are supposed to receive. Now the shareholder is only paying this much and 2500 he is not paying. So that here they have told us that maximum discount. Okay, so the company can give maximum discount for rupees 7500 because they have received this amount, and they can only charge at the time of reissue, they only want to get, that is 2500. So they can reissue this shares at 2.50 also. Fine, they can give maximum discount, that is possible. Or what they can do, so the maximum discount that can give on reissue of forfeited share is equal to the amount of forfeiture on capital which was received on this share. Again, this line will be clear when you will do the sums. That is 7500 is your discount, maximum discount, because this much amount you have received. Okay, in such case there is no need for any sanction for discount amount. For example, shareholder has paid 7 rupees, okay, and 10 rupee per share, and has not paid 3 per share. If these shares are forfeited and reissued thereafter, maximum discount up to 7. See, this is your maximum discount 7500. Okay, so that is possible. So here they have given 7 rupees and 3 rupees. So 7 rupee you can give maximum discount to the shareholders. Okay, on reissue of forfeited shares, amount received from new shareholder is debited to bank account. If these shares are issued at discount, then share forfeiture account debited. Here, due to reissue of this share, amount of face value of the share is credited to share capital account. Fine. This will be all clear when you will do the sums. I'll teach you the entries. So here our theory portion gets over, and in the next video we will start the sums.